Inflation has taken hold and it is hitting the middle class very hard today. In this video, I'm going to show you what you have to do. I wanted to first look at inflation specifically and then break that up into number 2, which is Japan's monetary failure and what we can learn from those lessons. Number 3 is the big indicators to watch. So if I empower you, you'll be able to take the next steps. Let's go. When you measure things in US dollars or euros, you're going to get confused a lot of the time because you're actually trying to measure it in something that's always fluctuating on a day-to-day basis. Yes, you might get paid in US dollar or euro and you buy things in US dollar or euro, but there's something happening behind the scenes that people don't understand. And when you measure it in hours worked, it tells a really interesting picture. The average American would have to put in more than 64 hours in September to pay the typical monthly rent. Now that is a very telling story. You could see the chart there for yourself. So previously, up from let's say 2015 to 2020, it was let's say around 56 to 58 hours, and now it is 64 hours of work. That is something you cannot deny, because while wages may have increased according to their numbers anyway, you're seeing the price of everything going up dramatically. People cannot compete with this. When you have inflationary forces underneath you, lighting a fire up and you're behind, you're going to find it very difficult to keep up. Inflation has passed the point of no return. Once it hits 8%, history suggests that inflation sticks around. What does that mean for your money? So this article is basically just talking about all of it and all the factors here. If you want to check it out, I highly do recommend it. But you're seeing that that line of 8% had been crossed. Now you look at various indicators and they have started to come down, but we only know in time how this is going to end up. Or is it just going to be a small little delay before we bounce even higher? It all depends on what the central bankers and what we see going along with the fiscal side of it as well. Governments have pumped in so much money in different forms of stimulus, and doing so obviously has a direct impact on the prices that we pay for just about everything. The 1970s was admittedly a period of particularly severe inflation, but as the report points out, it's also the most representative of the monetary and fiscal regime that we inhabit now. There's no precious metal like gold anchoring the currency and stopping policymakers from embarking on inflationary policies. But of course, they won't do that. They won't look at that which is physical because that takes away from their fiat system. They don't want this to happen. And I think that really sums up what we need to understand as individuals, that we must hold our wealth in that which is real. Because when you have something real and tangible, it holds value over a long period of time, but you need to diversify. And I'll talk more about that here today. When you look at what Japan has done, this is the experiment that's been going on for decades, and we should be learning a lesson. Japan's yield curve control is broken. I want to make this very clear because Japan's doing a lot of different things, and I wanted to make it known. They are buying the ETFs. So they're essentially buying the stock market. They're buying the bonds. They're buying the debt of their own country. And they're doing something called yield curve control. Essentially, what you need to know is that they are buying these bonds in order to keep everything within a certain level. That's all you need to know. And what we can see is that despite their best efforts, they are literally throwing billions of dollars or yen into an incinerator. That's what they're accomplishing. They are taking the value of their people's currency and burning it. I hope that people realize this, because I have been told so many times before, for many, many years, for over a decade now, that the model of Japan is the model of success. And if this isn't an admission of failure, I really don't know what is, because they're throwing the money and instantly it's burned away. All of the real investors are gone. More than half of all the assets are being bought up by the Bank of Japan, the Central Bank of Japan, and or the actual government pension fund, the investment fund. And that shows you that you've got a real big problem. When everybody's heading for the exit, but you're the only one sticking around, I think something smells real fishy. Okay, then we have this. I thought it was funny because you look at the Japanese finance minister saying there was no policy contradiction between the ministry's yen buying to support the currency and the Bank of Japan's printing money to sustain its ultra-loose monetary policy. What are they trying to accomplish here? They don't even know anymore. They're just trying at this point to buy everything they can because everybody's heading to the exit. And my friend and yours, Janet Yellen, says no information on Japan intervening on the yen again. Apparently, she said, I'm not aware of any intervention that the Japanese have done, that they have indicated that they've done. Supposedly, she was on the inside scoop, they said, and apparently not. So I thought it was interesting the way that this has been going, and there's so much back and forth, and really all governments are doing the same thing. Japan's just ahead. They've been doing it for a much longer period. Then we have this, Mr. Yen says the currency could plunge further and 170 per dollar is well in the scope. So this is just one of many people talking about this, that the failure will result in a devaluation even further on the currency that puts pressure on the Japanese people. People don't realize this, but when you do these experiments, you ruin this for a lot of individuals, and that is so truly unfortunate. The average 60-40 portfolio of stocks and bonds is down a gut-wrenching 34% this year, its worst performance in a century. That's why money managers like Goldman Sachs and BlackRock are experiencing a historic shift. They're urging clients to invest less in the stock market and more into alternative assets. Goldman specifically calls out alternatives like precious metals and fine art. But why art? Because even with 2022's losses, Morgan Stanley reports that the average piece is selling for 26% more than this time last year. And the last time inflation was this high, art appreciated an average of 17.5% per year. That's according to the Masterworks All Art Index. Masterworks offers shares in these multi-million-dollar artworks from legends like Picasso and Banksy, and they've delivered results even in 2022. That's right, in early October, Masterworks exited a painting for an exceptional 21.5% net return to their investors. In fact, Masterworks has strategically exited 6 positions, each for a net return of over 20%. So use the link in the description to sign up for Masterworks. Some are calling for a pivot to see what would happen in the future. Nobody knows though, but you could see in the example of Bank of Canada, instead of doing a 75 basis point hike, they did a 50 basis point hike. They're continuing their quantitative tightening, barely, of course, just like all central banks. They don't want to spook the markets, but this is what's going on for Canada. And this happens to be another closely watched recession alarm ringing. What are they talking about here? Well, it's this. No, not a scribbly line on a piece of paper. What we're talking about here is a yield curve inversion. You've probably heard of this before, but I'll just break it down very simply. Imagine you're going to take on 30 years debt. Well, you would expect to get a better return than, let's say, 6-month debt. And why is that the case? Well, there's more risk the longer you go out. But in this case here, what's happening is that's reversing, and that's called a yield curve inversion. So what we're looking at here is a very important one, and that is the 10-year 3-month. And now, just imagine you're going to get a better return on a 3-month than a 10-year. It's so wacky and wild, but that's where we're at. So this was actually from a few days ago, but all I'm trying to show you is that this happened to be inverted. Now, why the 10 and the 3? Well, this is a report directly from the Federal Reserve, okay? And in their conclusion of that report, they said this: our analysis suggests a number of practical guidelines for the use of the yield curve to predict recessions in real time. Starting from the second point, Treasury rates are the most likely to produce accurate forecasts. The best maturity combination may be 3 months and 10 years. Okay? They're saying it. The Federal Reserve is saying the 10-year, 3-month is the one to watch, and that has triggered. So you need to understand that the Federal Reserve saw that. They are noticing that. So if they believe there's going to be recessionary forces, maybe that means they're going to back off of their tightening. Well, we don't know until the time comes, but I just want to show that to you. This is so key. What is the ultimate factor here that nobody wants to discuss? Is that the middle class is being punished left, right, and center, freezing in winter due to lack of money. This is the share of population reported that they cannot heat their homes adequately in 2021 in percentage terms. Bulgaria at the top of that list. Then we have Greece, Spain, Romania, and so on. But if you look at the United States, you see that certain areas people are absolutely struggling. It is the inflationary forces lighting a fire under people and unfortunately hurting them big time, because they were sold this idea that we could have, oh, everything's going to be all great for this long period of time. You're going to be able to buy anything. It's going to go up forever. We're going to make easy money. We're not going to allow you to save your money in the bank account because you're going to get burned there. So you're going to make sure that you're going to put your money into the riskiest of things, and somehow that's going to be okay. And people are learning that the hard way today. Look at Facebook stock. Facebook was one of the biggest companies in the world at one point. Zuckerberg was one of the richest, in the top 3, I think, at one point. And now look at 70% down from its high. 70%. How do you recover from that? You need to go multiples higher just to get back to where it was at its highest point. Now, that's just one example, an extreme example. But we have to take this for what it is and understand that what was there last year, what was there 10 years ago is not here today. We've got a very different world, to say the least. Okay, really quickly, I just want to show you the fact that Yellen warns, by the way, this is a really Yellen day today, dangerous and volatile environment as she pledges to bolster the treasury market. See, what are they going to do here? Are they actually going to go in and do yield curve control? My goodness, I don't know. But if they do, we're going to be in big trouble because they didn't learn the lesson from Japan. And then you see the companies, this is just about media companies, but essentially that they've begun laying people off. Why? Because they see the writing on the wall. They know what's happening here, and it is unfortunate to look at it. Oh, you cannot, absolutely cannot deny what's going on here. You see that once we move through this cycle, that what comes up on the other side is what we need to be concerned about. Okay, because if this cycle takes, let's just say, a year or 2 years, maybe it's a mild recession, best case scenario, everything's okay, they lay some people off or what have you. But when it comes time to start hiring people back, what if they've got all the self-checkouts, they've got the iPads instead of tellers at the bank, they've got online everything that you need, you don't need to see human beings anymore. All of these things are being implemented today at the fastest pace they can. They're failing on things like autonomous driving, even though they're pumping in $100 billion into it. They're not able to get everything necessarily, but understand that they're trying their best, let me tell you. Then we have what we look at here with Walmart. They're doubling down on their self-checkout. Yes, we see that to be the case, as well as a major update at Starbucks, new tech promising better customer experience. The staff are not too happy about it. What is this? Essentially just trying to streamline using robotics, using automation, using these different applications. Well, this is not very good for the workers who are saying, hey, we want to unionize. Hey, we want more money. We want more pay. We want all this. And they're saying, well, you know what? We're just going to replace you with a robot. What do you, the individual, have to do? Let's talk about it. You need to get your investments right. And I want you to think outside the box right now, because this is not a time in which we should be doing the traditional things, okay? Inflation is high, and that means currency is declining in its true value. Remember to always measure what you're looking at in something different, not just US dollar all the time. Trying to save money is a losing battle because of the central banks and the government spending. We know this to be true, and we don't need to really be guessing that. I mean, we could see it right in front of our very eyes. Hold and keep what you have in what has historically been a safe haven. Physical assets like precious metals, cash flow real estate, not just real estate, but cash flow real estate, fine art, collectibles, land, etc. Things that are tangible. That's really key. If interest rates fall, risk assets become more attractive, but their value fluctuates wildly depending on market psychology. So tomorrow it's hot, the next day it's not, and you look at what the example I gave of Meta or Facebook. This is one, but there's so many examples of this. If you read the book Psychology of Money, you get that understanding that most companies, most of them, actually fail no matter how big they are. So we need to watch out. We need to look at what we're doing and pay close attention, because we're not going to be able to just throw our money at anything and assume that it's going to last forever, okay? Be smart with your assets, know what you're doing, and be prudent and wise. I hope that it was informative to you. You got to subscribe, hit that button down below. I'll see you tomorrow.